Hi, this is Kerry Artak with Wicked Stocks, bringing you an analysis of the iShares Russell 2000 ETF, the IWM. This is the small cap index, as it's commonly known. This is a monthly chart of the Russell 2000. You can see that in the month of April, we just began May, by the way, monthly bar chart. This is almost a 5-year span right here. We came close to testing. The low was 171.73, and you've got 164.48 as a 3/8 downside Fibonacci from that November 24 all-time high against that prominent 2009 low. This was the banking and housing collapse sell-off. 164.48 is 3/8 back on that. It lines up nicely with the classic horizontal channel bottom at 161.94. So any downside dips into the mid to lower 160 should be considered buy opportunities for the Russell 2000 through the rest of the year. What's worth noting, though, is from the all-time high against that recent low in April, this index has yet to even make it back 3/8 of the way back up. 3/8 Fibonacci is 199.67. So this is a weekly chart of the same. I've opened this up. And so there's been, the rebound has been meager. We've yet to even test the 199.67 3/8 Fibonacci, whereas if I jump to the S&P 500, it actually on Thursday of this week, that is May 1st, tested the 563.02 5/8 Fibonacci. So the S&P 500 has made a stronger comeback, obviously, than the small caps. Small caps are generally considered to be more negatively impacted by tariffs, which I think this is very timely for us to look at this. There's a number of reasons for that. I could get into them, but primarily it's that their supply chains are long established. They're unquestioned until the tariff situation emerges. But many small caps have been importing from Chinese companies for the materials and their parts for 10 or 20 years. And those were established a long time ago. They have less flexibility in making those supply chain adjustments. That's one of the reasons. They also have less cash flow, so they weather these storms less well than the large caps. Also, they don't have an ear with the president. Most small cap companies, and there are many of them out there, they just can't call the White House and plead for an exemption to a tariff, whereas large cap corporations, and we're already seeing that in the news, can call the president and plead for exemptions. And the White House is actually, from what I'm hearing through different television shows, CNBC and podcasts, is that they're giving assurances to Fortune 500 companies that they're going to do their best to keep the tariffs much lower than 25%. They anticipate them coming down substantially from the levels that they're talking about. So this is also resulting in a rally in the S&P 500. But I don't want to spend too much time in the S&P 500. This is the S&P 500 Spider ETF, by the way. It looks identical to the S&P 500 index. The S&P 500 is, while we're looking at this chart, testing a long-term resistance area that below 558.99 to 63.02, we can fall back to 5-year channel support over the next 2 to 3 months, perhaps in the 440s, 460s. If we close above 563.02 on Friday, May 2nd, I see a retesting of this high of 613.23, probably within about 3 to 5 weeks. So that is that for the S&P. But, the IWM, or the iShares 2000, Russell 2000, it has yet to test its 3/8 Fibonacci. And so that's at 199.67. And there's also a descending, I'm going to open this chart up here, this weekly chart, and show you a descending channel. This is the last extreme channel you can create using all the different extreme waves. And that makes it actually probably the most significant channel in terms of trend moves, trend identification. You've got this descending, and this goes back really to the highs, November of 24, but we can use December. This is a 4 or 5 month descending channel top at 198.74. This is a weekly chart. So your 198.74 to 199.67 area is a zone of resistance that, as far as the IWM is concerned, can contain buying through the month of May. And from here, we can fall back to the low settlement price of 181.19 over the next 2 to 3 weeks, and over the next 2 to 3 months, all the way back into the low to mid 160s. Once again, 161.94 is a solid long-term support level, horizontal channel bottom, well suited to contain selling through all of 25. I will mention that if we were to close below 161.94, and I don't have the target mapped out yet, that would be a significant sell signal through the rest of the year. But until then, this is bottom picking territory. And the way I would frame it is you're selling the upper 190s through May, anticipating the possibility of the lower 160s by June, July. This is kind of a 1 to 3 month possibility, with 181.19 being a pivot point inside of that. You can see that is the low settlement price on the weekly chart, and it was established 3 weeks later and held a weekly low, and here we are. Now, as I said earlier, if the S&P 500, for instance, closes above 563.02, that's a good second quarter low. By the end of May into early June anyway, we should revisit the 613.23 all-time high. As far as the IWM is concerned, it has a lot more lost ground to make up. And what I'm confident anticipating is the 5/8 Fibonacci at 217. So if we close this week, Friday, May 2nd, above 199.67, this is a 3 to 5 week move to the 5/8. Bear in mind, the S&P 500, the Nasdaq 100, that is to say the SPY and the Triple Q, they are presently testing their 5/8 upside retracement. And so this is a very interesting kind of difference between the two indexes. Small caps are underperforming. They're heavier. They're prone to falling back below the upper 190s. If we close above 199.67 today, that is to say Friday, May 2nd, in the IWM, I have to assume that the S&P 500 will have closed above its 563.0258, and the Triple Q, which I would suggest you just go to wickedsmart.com and take advantage of our 5-day free trial. You'll be able to see that as well. So yeah, getting back to the Triple Q, closing above 199.67 is a go long strategy. No good reason to be short the IWM with a settlement above 199.67. You could reach for 215, 220 strike out of the money calls then that don't expire for 2 to 3 months out on this 3 to 5 week play. Until then, holding below the upper 190s, 2 to 3 week swing traders may reach for 180 strike out of the money puts that don't expire for at least, I'd go 6 weeks out on that expiration, that 2 to 3 week play, or you could reach for 160, 165 strike out of the money puts that don't expire. I'd go 6 months out on this potential 2 to 3 month downside play. Over time, yes, we can recover back to B, perhaps 244.98. That took out that previous all-time high of November 21 by just a hair. I mean, like a half a point before collapsing back. Interesting. So this is going to obviously be a very symbolic region, and I don't expect to see it anytime soon. I think this double top will hold probably through the rest of the year, just given the fact that the tariff situation is really not going to flesh out for a couple of more months. And we're not even sure if it's going to be diminished, the effects diminished. And if it's not, if it begins to have its effect on the economy, and the small caps will be hit harder than the large caps, we can quite easily fall back into the low to mid 160s over the next month, 2, 3 at the most. This will be an important pivot point through the rest of the year. I'll be updating you on these levels as we move through time. Otherwise, I think I'm just going to leave it at that. That's all I've got for this particular Wicked Stocks video analysis on the IWM. Have a great day.